Okay, here we go. This is a problem in Chapter 6 on merchandising, and the student requested some help on figuring out gross profit. So let's see if we can get this thing figured out. It says Hair World Inc. is a wholesaler of hair supplies. Hair World uses a perpetual inventory system. Following transactions summarized have been selected for analysis. Transaction A, sold merchandise for cash, 23.2, and cost of merchandise 14,797. So I got a little I got a little spreadsheet here. Let's see if we can make this thing work. We got sales, we got cost of sales, and to get gross profit, we simply subtract cost of sales from sales. And actually, the sales amount would technically be net sales, yeah? But for our purposes here, we can call it sales. And so we got transaction A, and it's 23.2 is the amount of the sale, and 14,797 is given as the cost of that sale. And so we can use a simple formula here to take sales and subtract cost of sales to get gross profit of 8403. Okay, transaction B, receive merchandise returned by customers as unsatisfactory. So customers are returning merchandise that they had previously bought. And it says, by the way, but in perfect condition. Why are we being given that information? Well, if you think about it for a second, you might ask the question, okay, since the merchandise is being returned, what are we going to do with it? Well, if it's in perfect condition, what do you think we'll do with it? You're right, we're going to try and sell it to somebody else. So there's nothing wrong with the merchandise, but for whatever the reason is, customer is returning it. So we're going to put it back into inventory. So and we have to remember that for each of these transactions, the sale and the cost of sale, there would be a journal entry that would have to be made. Okay. To record the sale, assuming the sale is on credit. Well, this sale was for cash. To record the sale, we would debit cash and credit sales. And then to record the cost of sales, we would debit the account cost of sales, and we would credit inventory. But this particular part of this problem isn't asking for journal entries, but we need to remember that journal entry is required for every transaction. Okay. So for B, the amount of the sale return, is 250. Now I'm going to show this in the sales column, but keep in mind that we wouldn't enter this as a deduction to sales. So we wouldn't debit the sales account. Rather, we would debit sales return and allowances. So I'm going to put this out here just to say sale return and allowance, SRA. And as with every sale, there is also a cost of that sale. So in this case, the merchandise return had been sold at $250 and the cost of that merchandise was $150. So we're going to have to also put that back into inventory and reduce cost of sales. And so the gross profit on that return is a negative $100. Now that might be a little hard to understand initially, but we could talk about it at a later time maybe. But think about it. Essentially, this transaction, a sale return, is kind of like a negative sale. So everything that was done to record the original sale would essentially be reversed. As long as that merchandise is in saleable condition, and the transaction does say that it's in perfect condition, so we will be able to return that merchandise to our inventory. Then in transaction C, it says sold merchandise on account, terms 210 net 30, $6,500. So let's put in the $6,500, and it says the original cost of merchandise. Merchandise was the cost of merchandise was $3,088, and again, gross profit $3,412. Transaction D, collected half of the balance owed by customer in C within the discount period. Okay, so I've filled in a lot of information on this transaction. Let me see if I can get this so that you can see it. Okay, I think that's better. For transaction D, the customer collected half of the balance owed. We collected half of the balance owed by the customer in transaction C. That sale amount was $6,500. So half of it is going to be $3,250, and the balance is $3,250. But we're focusing on this part of the transaction, which is the collection. What I've done here is calculated the discount. So we take the amount in B11, which is the amount collected, that's this $3,250, and we multiply by the discount rate. And of course, this assumes that the payment was received within the discount period, and it does say within the discount period, so that's going to be a $65 cash discount on this payment by the customer. And so the amount of cash we'll receive is $31.85. The amount of the discount that the customer gets is $65, and so we credit that customer's account for $32.50. Now what I've done with the 65 is put it up here in the sales column as a reduction. And again, as we did for the sale return and allowance, we need to show that this is actually a sale discount. So it's going to be effectively a reduction of sales, but it isn't debited to the sales account per se. It's debited to the sales discounts account. Just as this $250 isn't debited to the sales account, it's debited to the sales return and allowance account. but the net effect of both of these transactions is to reduce sales. Essentially, we go from gross sales down to net sales. But we still need to take a look at transaction E. Transaction E, and this discount has no effect on the gross profit. The discount is simply an amount that affects the amount of cash that we collect from the customer. Okay, now in transaction E, we granted a partial allowance relating to credit sales that the customer in C had not yet paid. So on this remaining balance of $32.50 in transaction E, we are simply granting an allowance. Now, allowance in this situation is basically a price reduction. So on the remaining $32.50, the customer is going to owe us $31.46. But going back to our initial objective here is to figure out sales, net sales, and gross profit. The 104 essentially is a price reduction. There's no cost attached to it. So we can show it as a reduction in the sales column. However, again, just as we did for the 250 sale return, we show it as a sale return and allowance, but again as a reduction in the sales column with no effect on cost of sales and hence no effect on gross profit. I'm sorry, there is an effect on gross profit, which is equal to the amount of the allowance given. So here we have pretty much the numbers that we are looking for. We have the sales. If we put these two together here, we can see that our gross sales come to, why isn't that showing? Use the wrong sign. We take this plus this equals, okay, so our gross sales is 29.7 and our net sales, which we have calculated in this little spreadsheet section here, 29,281, and our gross profit, if all of our work here is correct, should be 11,611. So with this, I'm going to close this video and send this out to the student, and the student can go ahead and take a look at it and input that amount into the problem and see if it works, and we'll go from there. As far as I can tell, this should work. So the proof will be in the pudding. We'll check it out. Thanks. Aloha.